Hey, buddy, Tim Harrison, Straight Up Mortgage Talk. Today, we're going to talk to the world famous Nona Tirre from State Farm Insurance. She's going to talk to us about homeowners insurance, how to protect your asset, the home, how to protect yourself from the liability, what can happen to you, and 3, how to save money by managing your homeowners insurance policy better. She's going to cover all that, so let's get started. Hey, Nona. State Farm Nona Tirre is on our call today. We're going to go over homeowners insurance. Super excited to have her on. So Nona, let's get to it. First question I have is what everybody has. It's like, what is homeowners insurance? Like, what is the basic policy? What does it do for people? Why do they pay for it?
Okay, so homeowners transfers the burden of risk from the homeowner to the insurance company. So when there's a covered loss, like the home catches fire, a pipe bursts and floods the house, all that damage is covered by the homeowner's policy minus the deductible. So these are, your home is your biggest investment. And so you want to protect it properly. That's what the homeowner's policy does. There's a lot of details that go into that, but that's the gist of it.
Okay. Yeah, and that makes sense. So basically, like me, my roof blew off and I'm like, holy crap. I paid a contractor that wasn't as good as probably should have been because I was young and stupid, but because I went for the cheapest deal, heavy winds, my roof blows off, brand new. And lucky for me, they pay for stupid and I got a new roof out of the deal. So, I mean, I was like, holy crap, I couldn't afford the first one, let alone the second one at the time. So homeowners insurance, again, covered that risk, which was awesome. So very well explained. So, okay. So tell me the advantages when they're getting a homeowner's insurance policy. Actually, before that, let me go back. So I have my homeowner's insurance policy, covers the basic stuff. Get into a couple other items, like, it handles the risk. Okay, risk of something happening to your property, slab leaks, whatever else, those kinds of things happen, roof gets blown off. But what about the liability of somebody getting hurt on your property? I'm assuming that's part of the regular policy.
Yes, so that's the
Okay.
liability component of the policy. And
Okay.
and it could be you've invited somebody to your house or an uninvited guest. They happen to hurt themselves on your property and they sue you, your liability kicks in. And also to note, your home is one of the biggest assets that you own. In addition to
Right.
the homeowners, you need to consider an umbrella policy too. So that's another can of worms we can go into. However, the two in conjunction work to protect your overall liability, to protect your assets, your home, retirement accounts, all of that. But we're in California. Anybody can sue for anything. So
Yeah.
you definitely want a good liability policy in your homeowner's coverage and an umbrella to boot.
So just to summarize that a little bit, we've got, hey, something wrong goes with the property. We're gonna call, Nona at State Farm and go, hey, I have a claim here. I got a problem. If somebody potentially slips and falls, hurts themselves up to a certain level, State Farm's going to insure that. I've even heard of like people who are robbing houses, and then this might be one of those, bull crap things that hit the air, right? But like they actually sued them because when they broke the window, they cut themselves because they created some sort of unsafe health environment. It's like, okay, again, only in California. But the other items I'm wondering about is what about not on the normal policy? Like, those people like you that have like the chandelier wedding rings, that kind of stuff. Those are in addition to, correct? So what are some of the things that are so most common that people sort of insure and they sort of add to the homeowners insurance policy as add-ons, I think you would call them?
Well, that would be under the personal property of the homeowner's policy. And that's when you
Okay.
need a really good agent to determine what you can include in the homeowner's policy versus what you need a separate personal article policy for. For example, if you have high-end Persian rugs, you're going to want to insure those separately. There's also a difference in deductible. Your homeowners will have a few $1,000 deductible depending on the
Mm-hmm.
dwelling, how big of a home, right? And so the Persian rugs, you may want to have a smaller deductible, or your jewelry is limited you have limited coverage in the homeowner's policy, and you may have that grand $20,000 diamond ring, you're going to want to insure that separately. And those personal article policies, those outside of the homeowner's policy, they're very affordable, and the deductibles are excellent. This is why you need a professional to talk to. Go over your concerns, go over what you need insured, and make sure that you're properly insured in the home and anything that extends past that coverage.
And so just to kind of rewind just so people understand is you got the homeowner's insurance and that protects your home. It's a slip and fall. You can potentially add jewelry, Persian rugs, that kind of thing. When you talk about umbrella policy, that's kind of like next level. And that is where maybe you have, for example, like I do rentals or other things that might be putting you at risk. And, the number one risk is your car insurance doesn't cover you enough. And, you make a really stupid move, you text, you run over and hurt somebody really bad, kill them. You could end up putting your insurance policy just won't be enough. And that umbrella policy covers you for all these other things that potentially could happen. So you don't lose everything you worked for. So that's the umbrella policy. That's second level kind of thing. Right now, we're going to focus on homeowners insurance, but keep that in the back of your mind because those are the things that are very important to talk to an expert homeowners insurance on. So you mentioned deductibles. So I happen to go with really high deductibles, and I think it's because I can get cheaper homeowners insurance on the policies I have. And the other thing is, I kind of feel like I can get a good enough deal if I ever had a big enough a claim or something that I could probably absorb that deductible based on the work I'm getting done or how well I get the work done or cheaper, whatever I get the work done. Explain to people the advantages and disadvantages of sort of higher and lower deductibles.
Okay, so I'm with you, Tim. I like to have a higher deductible on my homeowner's policy compared to my auto policy. Totally different. The homeowner's policy, one moment. Sorry, we got to cut. Thank you.
Are people bugging you? Do they not know that you're in a podcast with Tim Harrison, straight up mortgage talk?
Forgive me, but you know what?
Did you just
I'm
like
accessible.
sign on the door? I'm talking to Tim Harrison, straight up mortgage talk.
I need a red light. Okay, so back onto that.
Hey, this is homeowners insurance, not that. Come on, girl.
State Farm is red. So on the deductible, so you're by having a higher deductible, you're saying that you're going to cover out of pocket expense up to like $5,000, $10,000, depending on how large the home is. And most people don't file a claim, like maybe once every 20 years, and it's going to be a large claim. You're not going to file for a couple $1,000s. So why would you pay that premium for a lower deductible? You got to understand the homeowners isn't to pay for maintenance, right? It's for those large catastrophic losses. And you hope to never have them, but you have the policy just in case. So the benefit of the high deductible is that you have the lower premium. However, you have to feel comfortable. And so, the customer can, maybe the 5,000 is far out of reach and they're more comfortable with a $2,000 deductible. In the end, you have to go with what you're comfortable dealing with. And then I've had customers that have graduated a few years later after their first home to a higher deductible. But either way, you're right. As long as you understand what it means. I too am with you, Tim. I like the higher deductible because I feel that I'm not going to file the claim for something small anyway.
Right. And then, so you said, look, you're not going to file a claim for $2,000. And the reason you're not going to, two things I want to point out. You said it's not car insurance. Yeah, your car moves.
Right.
You have lots of things that can happen to your car. Your house does not move. If you maintain your house, things probably don't happen. If you don't hire an idiot roofer who doesn't do the job right, put enough nails on the dang thing, your roof doesn't blow off in the wind like mine. So most of the time, unless it's big, like your house burns down, you have a major flood or something, you're not going to go out there and do first of all, you're not likely going to have the chance of having a claim like you would on a car, because of course it moves, it's way up more at risk, versus a home just sits there, right? I mean, it's not, again, not likely to have a claim. People don't have that many claims. I think I've had like 2 claims in my life and I have 10 properties, and then that's over 30 something years. So it just doesn't happen as often. Explain how the deductible works. It's not like, hey, here's $1,000 so I can get my work done. It's reduced from the amount they give you for personal property and all that kind of stuff. And as much as people a lot of times like to complain, insurance companies are pretty liberal on what they pay you when you do have a claim, and you have like usually a bump of some additional extra coverage to cover things. So usually the deductible sort of works its way out, like what you got to replace your TVs and whatever else you probably don't really come out of pocket technically. Does that sound right?
Yeah, we're pretty generous. I mean, every carrier is a little different, but if
Correct.
overall we're very generous that the overall amount that you receive compared to what you've lost, you're right, that your out of pocket expense really is reduced when you calculate the whole thing. And we don't, you're not paying the insurance company the deductible. This is something that you're paying the contractor, right? So we pay you, you pay the contractor, and you negotiate your rates and fees and what have you with the contractor that you hire. Remember, the
Right.
insurance is there to pay the bill. They're not your contractor. So you
Right.
have the flexibility of working with your professional contractor that you hire.
Yeah. So you're going to charge me $3,000 to get rid of all this stuff. Like my boys and I can do that, right? We'll clean that stuff out so that we don't have to pay the deductible. There's ways to work around that. So that's
Definitely.
kind of how I was getting at. So let me see. So the next thing, bundling. So we've got first time home buyers. They come in and they go, oh, I'm going to get a, homeowners insurance. We say, hey, call Nona. She does homeowners insurance. And maybe they're with one of these companies that specializes in cars and stuff, but they don't really do that great on homeowners insurance. And so what I've found is that when you bundle your car and your home, just like in raising your deductible, you get a lower annual. And of course, to us, lower annual means lower mortgage payment, which we like. So how does that work with bundling? Why do they get sort of the discount if they think about adding their cars and maybe seeing if that lowers their car insurance and their homeowners insurance? Because you guys are getting more of the business, basically, right? Is that
Right.
right?
So the
Okay.
carriers will give you a bigger discount on both ends. They'll give you a bigger discount on the auto policies when you have a home or renters or condo. And the same thing on the other side, the homeowners, renter, condo policy will give you a discount when you have the autos. And the carriers see it as they have more of the pie, so they can afford to give you this discount back. And then there's also, when you said new home first home time buyers, what I they tend to misunderstand is now you have this big asset that you just invested in. You not only need to protect that asset, you have to protect your liability in the auto. So I do find that we go through a discussion on raising the auto liability
Oh,
coverage to give a full protection. I really like, we talked about the umbrella. I like to offer the umbrella right out the bat because that gives you that full level of protection. And it's better to be prepared for the
got it.
worst
Well,
case
you guys like to
scenario.
insure everything, so I
I
get it.
insure
But
everything.
what is really important there, and that I didn't think to ask you, and it would have been at the end when I say, what should have I asked you, is that you're saying now that you have this asset, like when you just had a car and you didn't have a bunch of net worth and all that kind of stuff, like there's not a lot people can come after and sue you for. But now you've got this asset, you put 20% down or the value goes up. Now you actually have net worth and assets people want to go after if you get into a car accident. So you're saying we raise the automobile coverage too, because it's important to be covered there in case they try to go beyond the car to the house
Right.
because you didn't have that much coverage. Or maybe what's the minimum for the state? 5,000 or something?
Minimum's 15,000, 30,000 total, which is nothing. That doesn't pay for
Right.
hardly
So
any
you're right.
medical.
So
So
all of a
anything
sudden
over, yep.
they're coming to you and your personal assets, which means probably the house is right up there on that. Got it. Really good point. I'm so happy you mentioned that. Okay. So what happens if somebody calls you for insurance and they personally have had a previous claim? I'm guessing it's just on property, or the property itself has a claim against it. Like I think you guys get like sort of wigged out after a while if all of a sudden that same property seems to start having problems in a row. Like maybe that's a lemon, or maybe that person likes to make claims for no reason, which kind of goes back to, you're not going to make claim for $2,000 because you're going to get your homeowner's insurance raised and you're going to end up paying it back anyway. You don't really want to make a claim for something really small. You should sort of almost self-insure to what you can afford to, so that you don't end up paying for it down the road. And then again, so just explain, like if somebody has too many claims, how does it affect them, and how you guys have that secret underbelly belly deal that you insurance companies use to find out, like, they made a claim with that company, and that company, because you guys have the database, right?
Yes, we do. So there's a couple of things that you mentioned there. The claim history actually follows the owner. So
Okay.
first, let's say you have a new homeowner, first-time home buyer, or a new purchaser buying this one property that had a claim in the past. That does not affect their qualification for the homeowner's policy.
Interesting.
What does is, if you've had claims in the past, and we usually look at 3 to 5 years of
Okay.
claims history. And recently, in regards to my carrier, every carrier is different, but most
Okay.
A-rated carriers limit claims within the first 3 years. If you've had a claim recently, you have to go to someone else who's going to be a lot more expensive. That's what happens when you keep having claims, your premium goes up.
Right.
But in our case now with State Farm, if the claim, let's say it was a busted pipe and it happened a year ago, and you repiped the whole house, well, that's most likely not going to happen again. And you may be eligible to write with
Right.
State Farm within the last 3 years. So every carrier has a little different underwriting requirement. However, in the long haul, the more claims you file, the higher chance you have of getting non-renewed, because it's not like your auto insurance policy where you can keep bumping every corner if you're a poor driver, or you keep getting hit on the freeway. This one here with the fire policy, your homeowner's policy, you file a bunch of claims, and especially if they're little ones, these aren't like drastic ones, like they stole your bicycle out of your garage and you're filing a claim for $500 difference from your deductible. You're a risky customer in the eyes of the carrier because it's not how the policy is used. So you can get non-renewed. Your premiums will go up, and your premium goes up if you file a claim, even if the carrier does not pay out. So there's another
Oh, you made
important
a
piece.
claim and
And
they
it was
determined
not
that the bicycle's
eligible.
only worth $500 and your deductible's $500 and they don't pay out, you still got record of making a claim?
Yes, or let's
Damn,
say it's not
harsh.
eligible because it was a maintenance issue, not an accidental, let's say the pipe was leaking for 20 years and you just decided to fix it. Well, that's not covered. That's a maintenance issue versus a pipe burst and flooded your house. Well, that's going to be more like a covered
Got it.
loss, right? So that's why it's important to have a professional you can call and talk to before you file a claim. Like, hey, Nona, I'm not sure. Is this a covered loss? Well, you know what? I'm not sure. Let's get some people out there and see what the cause of loss is. And then I'll give you the possible scenarios and you can make the decision whether or not you're going to file the claim, because it's your choice at the
Awesome.
end of the day.
So something you said sort of struck a deal in my deal is it's like, people are going to think, well, why am I paying for insurance if I can't make a claim? She's saying, don't make a claim. What they don't understand, and this is where I kind of like to tell people, is the reason why they like higher deductibles is because for a company like yours with the laws and everything they have to do, it's, the cost is not the $500 to replace the bicycle or the $20,000 to do the piping and everything. It's the cost of having a claim person go out there. They investigate, they dry the carpets, they do all these other things. It's just to put that in motion, the number of people involved at a state farm to get that claim from start to finish could double the cost of the actual claim. So it's not like they're saying we don't want to have coverage. What we say is that it costs so much just to get it done that for a $500 deal, it might cost them $15,000 in team and staff and everything else. It's not that you don't want them to make a claim. It's just that it's not cost justified. If it's not cost justified, they have to charge you more. That's how it works. So I just wanted to kind of be clear on that. It's not that you're not wanting to make claims. It's just, it's a, what does it cost us to do that? And do we have to pass that on to people? And what's nice about insurance is you're not passing it on to people who can go out there and fix their own thing or not make claims all the time. If they're the kind of people who make claims all the time and are abusing the system, they get to pay the piper. And those people who keep their properties in good order and don't have claims as often because of that, they're going to get the benefit of that. So
Right.
that's what I like. That's what I like about homeowners and even mortgages, right? You pay your bills on time, you get a better rate. You don't,
Right. Same
It's the
thing.
same thing. It's about risk versus reward. You get rewarded for reducing the amount of risk to the mortgage company or the insurance company. That's
That's right.
how these things work because it costs us less to do business with you.
That's right.
There's less risk. So, all right. Talk to me a little bit about earthquake insurance in California.
Okay, so earthquake, there's other carriers out there, but State Farm and some of the other A-rated companies use California Earthquake Authority. So it's not, earthquake coverage is not covered in your homeowner's policy. You actually need a separate policy, just like a flood policy is not, floods aren't covered. You need a flood policy as well. But in regards to earthquake, we use California Earthquake Authority, and it always mirrors the dwelling, which is how much your home is insured for. If it burned down, how much is it going to cost to rebuild? That's the dwelling. The earthquake policy matches your homeowner's policy. It's a companion policy. And the way that the earthquake policies work, they're a little different because the deductibles are really high. It scares people off. You should not be afraid of the deductibles. I'm on this one as well. Personally, I like high deductibles because I'm going to get something no matter what. Right. So in regards to the earthquake policy, the deductibles range from 5% all the way up to 25%.
Of
So
the
dwelling. Of the
cost.
dwelling. So
So if I'm
just
insured for 200,000 on the dwelling, my 5% of that dwelling is 5% of 200,000
right.
that I
That's
would come
right.
up for or repair before. Now, what people don't get and don't understand is that if an earthquake hits and stuff, to get access to that deductible and that kind of thing, if we have major problems, is there will be government loans through FEMA that will help us cover those things, but maybe not cover the whole kit and caboodle, which could be very, very harsh, right? So that's why, yeah, you can have a higher deductible and it could be 20, 30, 40, 50,000, but at least that's a loan you could get through FEMA. FEMA is our federal.
Emergency. I forgot the M and the A, but
Me
yes.
too. So, but basically, the government, federal government, on part of our taxes puts it into a separate deal that helps when disasters happen. And one of the ways they help people is to give low cost loans so that things can be rebuilt. But if you have a big claim, you also don't want to go out there and have your mortgage doesn't go away. You still have your mortgage. And then you still have to go and get these repairs and stuff. So that earthquake is sort of the catastrophic category insurance. And it's run by the state, correct? And it used to be it's run by the state.
It was created by the state, but it's like a dotted line. It was enacted right after the Northridge earthquake. So I think it was like the mid 90s.
Yeah.
And a good piece about that is, so just to keep numbers easy, because I like to give this example, if your dwelling's 100,000 and your deductible's 20%, 20,000, and you get an estimate that your repair cost is actually 120, they're going to give you the whole 100,000.
Okay.
Or if, let's say, your estimate to rebuild is 100,000, they're going to cut you a check for 80,000. They're not going to say, homeowner, pay me that 20%.
Right.
They're going to give you that money, and you're going to go with that money and try to repair your house the best way you can. So the deductible is not something to be afraid of. You will still qualify for FEMA aid as well. That's another pushback I get from customers thinking, well, will that disqualify me from the aid? And it does not.
Good.
There's other components within the policy that are very important. So there's loss of use within this policy. And I like to maximize the loss of use, because if we have a big earthquake and your house is red tagged and my house is red tagged, we're going to have to live somewhere. We're going to have to breathe somewhere else, put our heads down somewhere else. And that costs a lot of money. And so loss of use is an excellent resource in this policy that you do not have to pay deductible for. So
right.
for
So
these
for
policies, that's
example,
important.
I got a $2,500 mortgage. My earthquake hits or my house catches on fire and I can't live there. I got to go find another place to live, and I got to live there short term while it's getting done, which means I'm going to pay the piper because I can't do a year or 2-year lease. And I got to try to find a place for short term. The insurance companies, you still have to pay your mortgage, even though you can't live there right now. Now, again, sometimes, don't not pay your mortgage. If you can't, you need to call them and work out a deal. A lot of times they'll work with you, if you're unemployed or something like this happens, they'll defer. Let's remember that. But the normal deal is you still have the responsibility for principal, interest, taxes, and insurance. You got to go live somewhere else, which means now you could have a double housing expense, which ain't too easy for anybody. And so the insurance policy actually covers that as well. It also covers if you have an investment property, meaning a rental property, and that happens to one of your renters and they got to go live somewhere else. You got to be able, you're not going to be able, they're going to have to go live somewhere else during that time. And so, or they say, look, I'm not going to rent the house anymore. I can't live here. It's burnt down. So hello, goodbye. And then you're going to have loss of rents while it's getting done. They're going to give me those loss of rents so that I could either put them up somewhere else or pay myself if I'm not getting any rents. Correct?
That's right.
So those are all those things that's covered. So there's a ton of stuff that you really need somebody like Nona in your life so that she can manage these things, because you hate to work so hard for that asset. You hate to, all of a sudden have this lovely house, have all the stuff you've worked for, your families, that your home, and then it's all wiped out because it wasn't properly insured and covered. So knowing how to figure out what kind of insurance I should have, how to save money, how not to overinsure, how not to underinsure. It's super important. It's not something that just happens on the internet. Like, you can't ask questions and just go, oh, well, this is what I need. You really need somebody who's an expert. And I believe in the same thing in mortgages and in homeowners insurance and financial planning. Those experts can actually save you a lot of money by knowing what to do and be there when you need them, right? But the most important thing that I have to ask you, do you have a pair of khakis and a red shirt? Or is that only for Jake? Does only Jake get that? Because if I'm talking to you at night and my wife finds out who I'm talking to, she might not think like, well, he's not. Well,
I could totally look
right?
hideous,
I'd be in trouble.
so it's okay.
Plus my wife knows. Plus my
wife.
I
love your wife. I doubt it.
My wife Lori would be like, stop bugging her.
Yes. All right. I'd talk more with your wife than you then.
That's right. So honestly, when it comes down to it, super important to understand did I miss anything? I know there's a lot, right? They did. Like the basic, is there one like big thing, like you said, like he should have asked this? What an idiot.
Well, there's just a couple things I like to hit on.
Just slightly an idiot?
Sweet. No, not at all. You know your biz and I know mine.
There you go. That's why I have you on here for homeowners insurance and not me.
That's right. That's right. So dwelling, there's a few things. Even once you get your policy, the best practice is to review that policy every year if you can, or no less than every 2 years, because your insurance is not to set it and forget it. Your insurance, your needs change, your risks change, your liabilities, assets change, and your insurance needs to follow suit. In regards to the home, the dwelling is very important. Right now, the cost to rebuild a house is astronomical. So if you have your dwelling set from like 5 years ago and never changed it, most likely—
Meaning cost to rebuild. When you say dwelling, what does my policy allow me to rebuild this house if it was to burn down, and maybe it was 200,000 and that would cost 300,000 to do that? I need to know and adjust that, which you guys are responsible for adjusting that somewhat. But the biggest thing I've seen with my clients is that they gut the house, they redo their kitchen, they do all this kind of stuff, and they go to top end type of stuff, wolf, ranges and, all these kinds of things. And
brick
they don't
pavers
adjust
everywhere. Yes.
Right. But then they don't adjust their insurance to cover all those high end stuff, because guess what? When they insured it, it wasn't.
Right. It was basic, and now it's not basic anymore.
So you have to let them know that. So it's not going to cost them a ton more money, but you do want to be prepared to go back and get that wolf stove and all the stuff that you wanted. All right. What's the second thing I forgot? That's a really, really important one, because I had people back in the day with the fires who never had their insurance properly done. They hadn't been paying enough, and they didn't have people review. They didn't have insurance agent expert like you that reviewed their policy, and they were not getting what they hoped to get or should have got had they managed it properly to rebuild what they should have been able to rebuild, because they couldn't rebuild what they had.
Right. Well, on top of that, there's endorsements that will also supplement when there's a time of loss. So you've got a building ordinance and law. So we have an old house, and now you burned down the kitchen, and you have to build to code, where all that cost to code can come from that endorsement. You also have, like with State Farm, we have increased dwelling options where we give you automatically 20% additional dwelling coverage, or you can pay a minimal cost to get 50% dwelling coverage, increased
Meaning
dwelling
if
coverage.
prices have gone way up, like now because
You're
of COVID,
covered
lumber's
in
gone
between.
way up, you're covered during those extreme
Yes,
pushes.
peace of
And
mind.
if it's where like a fire hits and there's a ton of houses in the area, let's say up north or something, guess what happens? The cost to do everything goes way up because there's
Sky
only
high.
so many contractors and there's a ton of work. So prices get shot up. That adjusts for that. Super important things. That's why I come to you as the expert. I super enjoyed this because I learned stuff. It's so fun. I've been doing this for 20, 30 years, right? I know about mortgages, but
Right.
I really didn't know all I needed to know about homeowners insurance. So glad to have you on here. So one, I want to mention before you talk about how to get a hold of you, what's the easiest way to call you, text you, email you, whatnot, is one of the things I want to mention about Nona is that she speaks Spanish. And so she's not just English speaking, she's also Spanish speaking. So that kind of goes, meaning she can cover a whole heck of a lot more people. I wish I did. Ooh. So just to mention, speak Spanish. How do we get hold of you? If somebody wants to get hold of you, you want to get, maybe they, after listening to this go like, I really need to think about earthquake insurance. I really need to think about redoing my policy. I really should be thinking about bundling. I really should think about whether I should raise my deductibles and what does that do for me? What's the best way for them to get a hold of you? And what should they kind of have, maybe in front of them when they call you so that they can be prepared for that conversation?
Okay, so phone or text 909-544-7758. That's my cell phone, or you can email
And
me.
slow people talk?
909-544-7758.
Thank you.
And then you could email me, Nona at insuranceclaremont.com, and Nona is just Nona.
Do the email again, just because it cut out a little bit.
Nona at insuranceclaremont.com.
Oh, sweet. Aren't you cool?
Yes. Well,
awesome.
and as far as what they need, I could quote from anything without anything, but if you want to compare what you currently have to what I recommend, I'd like to have your existing declaration page for your homeowners, just so we could see, are you underinsured? Are you overinsured?
And declaration page is like the first page before you get into all the crap that has, what are you covered for? Yeah. And usually it has a summary of what your cost is, right?
Yes.
So that usually, that's the right page when it says you pay $900 a year for your homeowner's insurance or whatever it is.
Right.
Okay. And car insurance too, if you're talking about bundling, same kind of thing.
Yes. Well, I'll usually quote with and without the car, so you can see what your options are, what's your total out-of-pocket expense now versus what they would be if you bundled everything. I like to do Excel sheets, so you'll probably get one from me. I geek out over Excel. I know. Shameful.
I love it. All right. So that's how you get hold of Nona. Obviously, there's a lot more to homeowners insurance than we're going to be able to cover here. And everybody's situation is quite different, kind of like mortgages or financial advising or that you really need to get with an expert and really drill down. And Nona's the person that can help you do that. So again, Nona, thank you so much for explaining homeowners insurance and giving people the basics. They'll reach out to you, I hope, to get real specific with you. Thanks again, and we appreciate it. Bye now.